Hi, everyone. Welcome to Wharton Tech Talks. I'm Spandana.
And I'm Javier Torres, and today we're joined by AJ Jangalapalli, who is a principal on the Discord team at Thoma Bravo. Based in San Francisco, he joined the firm in 2016. Previously, he worked as a technology investor at JMI Equity and in investment banking at Deutsche Bank. He also holds an MBA with honors from the Wharton School. AJ, we're super excited to have you here on the podcast. Where are you calling us from?
Thank you. Yeah, I'm excited to be here as well. I'm calling from San Francisco.
Perfect. And, for our listeners, we just did a quick introduction, but could you share more about your career trajectory and what were the decisions that led you to your current role?
Yeah, definitely. I started my career in finance right out of undergrad in 2009. It was going right into the teeth of the global financial crisis, but as a rather dour MD pointed out, things look pretty bleak, but the good thing is it can only get better from there, and he was right. So I spent 2 years in investment banking, focused a little bit on media companies, a little bit on tech companies, a lot of telecom companies, and then moved into the investing world. I spent 3 years at a growth investing firm focused on software companies called JMI Equity. I was out in their Baltimore office, and then business school, and then 6.5 years now of buyouts in the enterprise software world with Thoma Bravo.
Oh, that's great. So tell us more about Tama Bravo. What is your typical investment thesis and what type of target companies are you looking out for?
Sure. So we are enterprise software focused investors, meaning the only companies we'll ever look to invest in are enterprise software companies or companies that sell software to businesses. And within that, we tend to focus much more on the higher quality end of the spectrum. So mission critical software companies, good to great unit economics, and most importantly, a management team that we're excited to back and where we think that we have alignment on a joint vision for the next 4 or 5 years for how the company grows. And the other big area of focus for us, which has always been a key tenet for Toma Bravo, is profitable growth, especially as you think about kind of the pullback in public markets today, some of the highs of the 2020 2021 era. A lot of those companies were encouraged to grow at any cost, to burn a lot of cash and try to overstate top line growth in any way possible. We've always been much more oriented around try to grow, but at the same time making sure that you're thinking about your profitability and you're building a sustainable business, not just something that can raise a lot of cash and then spend it all without necessarily creating a ton of value for customers or employees or your communities.
Yeah, and I think that way of looking things help a lot, and it helps in general during recessions, during tough times. The idea of having growth but combining it with a profitable outlook. We were doing some research, and in 2019, Tomorrow invested in Mailgun. Can you share to our listeners what Mailgun does and what's the investment thesis there?
Yeah. So Mailgun is a transactional email API service for developers. So what does that mean? It means if you're a company that's sending large amounts of emails, you can't just blast those emails out from your domain. You get treated like a spammer or a bad actor since that's how all those guys operate. Instead, Mailgun exists basically to help those companies send those emails and then most importantly have those emails get delivered to the inbox of the intended recipient. And what Mailgun did, it had a few wrinkles that made it really interesting for us. So, one, Mailgun is a developer focused API product. What that means is, as a developer, you're able to build an API call or basically have your application automatically reach out to Mailgun directly as you're writing the code for it, which means that you plug in Mailgun into your application and it's automatically running every single email you're trying to send without you needing to keep thinking about it. It sort of operates in the background very seamlessly. Of course, Mailgun also helps make sure that those emails actually follow the right procedures, don't trigger any red flags, and ultimately don't show up as spam or phishing attempts or anything negative for the big inbox providers like Google and Microsoft. The other big thing about Mailgun that made it different, one is that developer orientation. The other was had a see, try, buy model. Effectively, as a developer, you could go to Mailgun's website and buy it directly off the website. The joke was it could take you 57 seconds to sign up and you're already up and running with Mailgun. You can already start sending emails out. So those two things made it a pretty interesting business. The one other thing that I think people generally got hung up on, one of the reasons why we were successful winning the deal, we closed it in 2019. Many of you listening may be thinking, it's 2019. We actually have cell phones in wide usage. Isn't email dead? And the short answer is no, it wasn't. Email marketing had certainly become a little bit more of a mature industry. But as I mentioned earlier, Mailgun was more oriented around transactional emails. What are transactional emails? They are basically emails that are sent one off in response to an interaction between a customer and a business. So, for example, if you finish an online purchase, e-commerce store is going to send you a transaction receipt of what you bought. Or you have multi-factor authentication for a certain site that you're logging into, you'll get an email that's validating your login attempt. Or you finish a Lyft ride and you get that ride summary email. And so what we loved about the company, as you think about those use cases, it's not about getting a marketing blast for here's a sale on this product, 30% off for the next week. Instead, it's much more tied to things like cybersecurity, e-commerce, mobile adoption. And those tailwinds are much deeper and much younger in their cycle than email marketing. And so what we got comfortable with in our diligence was Mailgun was not going to be a 8% grower like the broader email marketing space was. It was going to be much more than that. And sure enough, certainly when we bought it, it was a pretty incredible business. It was a rule of 100 business, growing 60% with 40% EBITDA margins through our hold period. That 60% came down a little bit by virtue of just incremental scale, but it was still healthily above the 20-25% growth rate through our hold.
That's very interesting. I think the company has been performing really well in this environment. One thing I wanted to ask you was, given the last 2 years that a lot of things have changed in the macro environment, in the way consumers interact with e-commerce and how they purchase online, has there been any change in the strategy for value creation?
Yeah, so we actually ended up selling Mailgun. It got rebranded to Pathwire about a year and a half, maybe 2 years ago. We ended up selling it to a business called Cinch, which is a public company listed out in the Swedish Stock Exchange. And for the past year, I don't have a ton of visibility into how it's doing, but certainly, through the pandemic, it actually accelerated growth every single quarter as people became more and more reliant on another big tailwind around remote work or just general remote kind of interactions with businesses. Mailgun or then Pathwire became even more important as well as a solution. There was a lot that we had done with the company to position it for continued success. It was never really a one product company. We always had a couple of products, but we spent a lot of money building out a real product development org, investing more in R&D. Despite being half the size of our biggest competitor, we were always the first to introduce newer products to the market, along with better customer support throughout. Firm, we started pushing Mailgun to invest more in enterprise sales motion to complement the developer first, see, try, buy, low touch approach that we had before. We put in a lot of sort of structural, management tools like Salesforce, NetSuite, Zendesk that helped improve our real-time visibility of how the business was doing. And that also helped us with M&A. We were able to make two very accretive add-on acquisitions. We financed them all off the balance sheet, which meant no incremental equity, no dilution to our investment. And those businesses end up being similarly growth oriented, but also with a lot of profitability once we bought them. And all of that ended up putting Mailgun in a position where we basically 4x the company in a span of 2.5 years. Most of that's organic growth from Mailgun, but some of that was also from the acquisitions that we made.
No, thanks so much for the added color there. And, it's so great hearing from you directly about, why you made the investment. And in a similar vein, we wanted to focus on another one of your investments, which was Greenfire. Could you actually tell us more about Greenfire and what was your investment thesis there?
Yeah. So Greenfire is a provider of clinical trial payment software. They're actually right down the road from you guys. They're in King of Prussia, Pennsylvania, so right on the main line. So they exist because one big sort of feature of clinical trials, which is in clinical trials, the vast majority of them, participants are going to be required to be compensated for their time, their effort, the bodily risk they're going through as being part of that whole trial process. The payments to participants are triggered based on benchmarks like when they first sign up for a trial, when they submit their nth report on how they're doing with the medication, things like that. Similarly, the sites that are actually running these trials also get paid based on these benchmarks. These benchmarks are also pretty irregular. You can't just set up a recurring X dollar payment every 2 weeks and meet the criteria. Instead, you're trying to trigger these payments off of these sort of irregularly timed activities or benchmarks. And so Greenfire is the only software first approach to participant payments, and by far the market leader in terms of a product perspective on the site payment side. What they do is they integrate with all of the core clinical trial data capture and clinical trial management software systems out there, so that through those integrations, you're automatically triggering payments with the right amount, with tax withholdings, with all of the logistical hurdles of making these sorts of money disbursements across many dozens of countries across the world. And then on top of all of that, they've also got a product that helps automate logistics for participants. So getting them Ubers booked, getting a hotel if there's overnight stays, all of that to just make it a lot easier for participants to make it through a clinical trial.
Sounds like it's solving a lot of the pain points. And especially in the aftermath of the pandemic, I guess all of us know a lot more about clinical trials than we would have known otherwise. So great to hear about such a company. And I'm actually curious because, Greenfire sounds so different from, we just talked about Mailgun. So how does Greenfire fit into your broader portfolio? And are you actually looking to make more investments in the clinical trial phase, or how are you thinking about that?
Sure. Yeah, so it's definitely very different than Mailgun. In our mind, it's an A plus quality enterprise software company. That's what it's got in common with the rest of our portfolio. And the other thing that it's got in common is it's very much a growth thesis, but with a business that's already fundamentally proven it has great unit economics, a great management team. We saw the ability for us to come in, help with M&A, help with sort of thinking through the professionalization or institutionalization phase of, doubling it, tripling it over the next 4 years. And part of the reason I think we got so excited about it is the market opportunity for Greenfire is one of the best we've ever seen. The market is highly underpenetrated today. It's only around 10% or so of new trial launches that will currently see automated site and participant payments. Most of the approach today is still very manual. Site investigators and CROs that are doing this work, in some cases, literally stroking checks for participants for, $16 once a month or whatever it ends up being. It's an underpenetrated market today, which we love because software in general is going to be a more and more dominant part of every manual process today going forward. And the reason it's such a good fit for us beyond that market opportunity is it's also mission critical. If you do this well, if you get participant payments right, site payments right, you can create hundreds of millions of dollars of value, billions of dollars of value for pharma companies. By getting these payments right, what you end up doing is you give participants a much happier, a much less frictionful experience being in a trial. If you make their logistical problems easier, they're going to be more likely to show up to the trial in month 7 and month 12, month 24, whatever it is, which means they're going to stick around with the trial. They're going to help you get your data, get that much closer to getting approval to move to the next phase. Similarly, if sites are getting paid regularly, sites' biggest complaint today working with big pharma companies is going to be when they don't get paid on time. If you can get sites paid the right way, they're more likely to work with you. The best sites are going to have great ways of recruiting more and more patients. And so ultimately, you're building this virtuous cycle where using Greenfire, you can actually build an incredible brand as a pharma sponsor for participants who want to work with you, sites who want to work with you. And ultimately, it's going to accelerate your trial approval as well. And if you think about it, whenever participants drop out of a trial, it can slow down your approval by months, quarters, years, whatever it is. Every month that your compound isn't approved is a month you're not making money selling your drug. It's a month less of exclusivity you have on your compound. And so all of this value that you can create with a solution like Greenfire, that is what actually puts it very much in line with other software products that we own. It's all focused on great ROI for their customers, but doing it in a way where you have great unit economics as well. And so you've built a sustainable business capable of growing longer term.
Yeah, it's great to hear the focus on sustainability and profitable growth that you have had across the investments that you've made. Just taking a step back from hearing about all the specific investments, it's always great to get a peek from the investor side of the table. So, for our listeners, would you mind sharing what's the best pitch you've ever heard from a company?
Interesting. Yeah. The one that immediately jumps to mind, sort of the jaw dropping moment at dinner with the management team, was when I met the founder of Meridian Link back in 2018, Tim Nguyen. And he talked about how his company had reached effectively 100 million of revenue, 50 million of EBITDA, or 50 million of profitability, and had never hired a single sales rep. And he had gotten there just through a maniacal focus on his product, on making sure his customers had a great experience, and you just let word of mouth do the rest. And as an investor, it's hard to get more excited than seeing a business that's crossing the 100 million of revenue threshold without ever having had a single sales rep. It was just a beautiful business model, an incredible company, incredible product, and a great market leader even today.
Yeah, and sounds like a very interesting opportunity to create value too as an investor, focusing on the sales.
Yeah, very much.
I wanted to switch gears and talk about the current market environment. What is your view on the recent tech market pullback, and has it affected Thoma Bravo's strategy?
Yeah, so the market pullback is, I think in some ways you could say it was a long time coming. Certainly some companies are being impacted unfairly. By this time last year, you saw companies that were being valued at just ludicrous levels, 40 times forward revenue, 100 times forward revenue. At a certain point in the public markets, there was just no tethering of valuations to reality. And then even worse than that, I think there was a pretty unhealthy focus on growth at all costs in the public markets. We've heard public investors ask questions like, well, you're running your business profitably. Does that mean you have nothing less to invest in? People took profitability not as a sign of a successful business model, but as a sign of a mature product, a dying market, and a belief that growth wasn't going to continue going forward. And so, certainly in the heights of the highs last year, I think I probably saw a lot more irrationality, especially in the public markets, and how they thought about companies. Companies were being rewarded for burning cash, not generating profits. And so, with that context, I'd say the pullback in some ways is a little healthy. It's nice to reward companies again for acting responsibly with the capital that they have. It's nice to say, growth is always worth pursuing, but doing so in a profitable way, with a real focus on how do you create value for customers, for your stakeholders. It's nice to see that pullback reflected somewhat. Whether it's too much of a pullback or an overcorrection, that's a lot harder to say, but certainly healthy to have a little bit of that pullback relative to last year. And very briefly on whether it's changed our strategy, not at all. As I mentioned, we've always been much more of a profitable growth focused firm. In very, very rare exceptions will we actually run companies to break even, or we'd never run companies to burn cash. But in that sense, we've never needed to shift kind of how we think about creating value for our LPs. And I think the broader pullback has validated our maniacal focus on unit economics and growth at the same time without saying you need to pick one or the other.
And what about the enterprise software industry? Aside from the general tech market pullback, are you observing any additional headwinds or tailwinds that are interesting to mention?
Yeah, the tailwinds are the same that they've always been for the 12 plus years that I've been in the space, which is software is becoming more and more important as a part of everyone's lives. It's automating more manual workflows, it's driving more efficiencies in companies. And so one of the partners at JMI who when he was recruiting me, asked me the question, what better industry can you lever your career to over the next 40 years? And, I continue to think software is going to be the single best space to spend your time. On the headwind side, certainly the broader macro slowdown or fears of a macro slowdown will drive, a slowdown in buying cycles. You'll see it in public company commentary across the board. People are nervous about, is there going to be a recession next year? And therefore, maybe you'll preemptively pull some spend. The nice thing is for great software companies, you're not going to lose customers. People still need your software to preserve efficiencies, to run more effectively as a company. And so it shouldn't cause a lot of customer losses for the best companies out there. It may, on the margin, slow down your pace of adding new business, so it may slow down growth a little bit. But what we're seeing is it's only going to slow down the broader curve of software dominance. It's not going to shift the direction in any way. Maybe the only other headwind is around the broader input costs that we're seeing, labor, certainly the great resignation, things like that are just making it harder for any sort of company to operate, and software is not immune to it. And the best management teams we've seen are working around, how do you preserve talent? How do you put in place incentive structures? How do you make sure people come to want to work for your company as opposed to just trying to leave to find the next highest paying job out there? So it's all stuff that great management teams can manage, but certainly stuff that we have to consider as we're building an investment thesis.
That's great to hear. And, especially in a challenging macro environment that we find ourselves in, value creation is something that's, I'm sure, top of mind, especially for the existing companies in your portfolio. So could you tell us more about your value creation strategy overall? And if there are any specific strategies that have worked well that you'd want to highlight?
Sure. Yeah. So the most obvious one would be just focusing on accretive M&A. And now, probably more than any time I've been in the space, I think there's a phenomenal M&A market for good, profitable companies, companies that are growing and are in a stable financial position. Across my portfolio, we're seeing a lot of smaller names, companies that maybe raise some big funding rounds that are still burning a ton of cash. They're realizing that it's going to be really hard to grow in this environment. It's going to be really hard to get to profitability. And so we see a lot of opportunities where we can run consolidation playbooks, buy interesting products, buy interesting other competitors, and find a way to help them get through these broader macro environment that we're in. It's been one of the best times to think about M&A. Certainly it's harder and harder to finance some of this. The debt markets are affected just as much as the public equity markets are, but great companies are always going to find capital, even if the price is a little bit more expensive. And so we're helping our companies be pretty aggressive on the M&A front, and that's going to be a big driver of value for the next few years. The other big area we're focused on is looking internally, finding a way to preserve talent, finding the way to allocate resources the right way. We'll push companies to say, what are ways that you can take advantage of being in the position that you're in? So instead of thinking about growth only coming through incremental spending, is there a way you can think about growth through, more efficient spending? As an example, if you're hiring a bunch of new sales reps, you end up needing to split a really good pipeline across more people, some of whom are going to be less talented than the best reps you have. That's going to be a place where you'll see slower bookings, even though you've spent more money in your sales and marketing function. And so we'll push our companies to look internally and say, what if we don't make those hires? What if we rationalize down the team to only the most efficient folks? If you have a slower pipeline overall, fewer deals that are happening because of a macro slowdown, you want the deals that are actually going to be likely to go to your best reps and actually be more likely to close. So it's a lot of these potentially counterintuitive, but ultimately successful ways of finding a way to accelerate through slowdown and taking advantage of being in a position where you're already profitable, you're not cash constrained, but you still want to be responsible in how you try to gain share in this climate.
Thanks a lot for those insights, and really loved the last piece that you mentioned around, it's counterintuitive, but it might be the best way to forge forward and be more profitable. So I think that's very interesting to hear. And you mentioned something earlier on around, why you decided to join enterprise software and the pitch that was made to you. And, there's a lot of our classmates who are very interested in pursuing tech PE investing. Is there any specific advice that you have, or how would you encourage people interested? How should they be thinking about their careers? And what's a good way for them to be a successful investor in the space?
Sure. Yeah. There's two things I'd say. One is there's no substitute for experience, but short of spending 20 years, 40 years investing in software, the best way you can start to at least try to get some of the benefits of experience is just look at as many case studies as you possibly can. And obviously, courses at Wharton will help you get there, but there's some great long form journalism on how certain companies have operated, phenomenal case studies there for very relevant topics in the software world, like Adobe converting to a subscription model. How has Microsoft pivoted to where it is today, one of the most respected software companies on the planet? There's no substitute for just being able to read these stories and get a better sense for building a narrative around how software companies operate and how they grow, even through increasing challenges, disruption, things like that. So that's one, is just never stop trying to get these stories. And then two, a little bit more tactical, but the biggest thing you'll see certainly from folks trying to get a job in private equity is a resume and an email and a polite ask to chat to learn more about the space. I would strongly encourage people to try to be a little bit more value add. And it's not about how much value you can add, it's about making the effort. And so the next time you talk to a PE fund, don't just sit there thinking you deserve 30 minutes of someone's time just by virtue of reaching out. Instead, think about ways where you can be helpful, like maybe flag a couple of interesting software companies that might be good investment candidates, or share a market map that you may have built where, again, it's not about how accurate the map is or how many investments you can drive out of it, but more just doing a little bit to stand out from the crowd and doing a little bit to add value, just because I think it drives a lot more of a reason for the firm to take you seriously and be helpful to you in your career.
Awesome. Thank you for that advice, AJ. I wanted to switch gears to some fun rapid fire style Q&A. So the first question is, what's your favorite book or a book you would recommend?
Yeah. So on a nonfiction perspective, my favorite book is The Master Switch. It's written by former Columbia Law professor Tim Wu. He looks at basically how information empires are built, anti-competitive practices that helped the telegraph industry, broadcast television, the telephone industry, in the internet, even how all of these industries have kind of always been a step ahead of regulators and have used that to compound their own power. It's a phenomenal book. It's got a little bit of a legal bent, but a really interesting read, and especially fascinating for people who are interested in technology and technology investing. And then on the fiction side, Lucky Jim by Kingsley Amis is just one of the funniest books I've read, and I think people will be very grateful to have discovered it if you crack it open and get through.
What was your favorite moment at Wharton?
I'll say, so I was on the Atacama venture. We climbed up an active volcano, Mount Lascar. That was an incredibly grueling experience. It was north of a week of just some of the most fun, but just most challenging camping that I've ever done. And coming down Lascar on the second to last day, it was just one of the more gratifying moments I've had, just being able to do something that far off the beaten path, no pun intended.
What's your favorite company?
Well, I love all my portfolio companies equally, and I'll stay away from the TV portfolio more generally. I'll go with, I guess it's Yum Brands. Is that the one that owns Taco Bell, my favorite restaurant? So I'll put them as my favorite company.
Yeah. That makes sense. I've heard this one before, right? The companies are like kids
Yeah.
or children, and it's difficult to choose between them.
Yep.
Yeah. So this is a final question, which we ask of everyone who joins our podcast. So, what is your boldest, most unique prediction that folks might feel is a moonshot about the enterprise software industry, but that you believe will happen in the next 5 to 10 years?
Yeah. So what I think is going to happen is, regardless of what industry you're investing in the next 5 to 10 years, you're going to be an enterprise software investor. There's not going to be a way to be an oil and gas investor, a consumer retail investor, you name the subsector. You cannot invest in any of those companies in a vacuum without understanding the software context that underpins the success or failure of those businesses. So for anyone listening, I strongly urge you to get deeper, to get more literate with the enterprise software world, because, within 5 to 10 years, it's going to ultimately determine the success or failure of every company out there, regardless of whether they're strict software companies or not.
Very cool. Thank you so much for joining our podcast. It's a real pleasure having you on. And yeah, really, really appreciate you making the time.
Yeah, of course. Thanks again for having me. Always great to talk to folks from Wharton. And again, appreciate the time and have a good rest of the day.
Thank you, AJ.